from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Caroline Hyde in New York, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, the sell-off, it continues across the board. Tech is in the crosshairs as fears linger over the Fed's ability to tackle inflation. The Nasdaq 100, well, now down 10% in the last 3 trading days. Plus, crypto not spared in this sell-off. Bitcoin slipping down below 32,000, down more than 50% from its all-time high. My conversation with Galaxy Digital's Michael Novogratz about where he thinks the bottom might be. And look out below how the slide in equities is affecting the once-hot IPO market. We'll talk to one tech CEO who says, look, the traditional IPO process is actually a scam. We'll get to all of that in a moment, but first, let's get a look at the market's continued equity sell-off to start the week. Pandemic sweethearts seeing a significant slide, returning to pre-pandemic levels. Bloomberg's Ed Ludlow joins us. Extraordinary once again.
Right, it's a broad-based sell-off. In tech, one of the worst performing sectors, right? You look at the Nasdaq 100 as an example, third straight day of declines, down to its lowest level since November of 2020. We're getting back to that pre-pandemic question, erasing those gains. The focus on the Fed, of course. Really interesting the role that mega caps are playing in this. You look at the NYSE FANG Plus index. That index or basket at its lowest level since August 2020. Of course, it includes the FANG stocks, the likes of Meta, Alphabet, Apple, Amazon, for example, but you also have the US-listed shares of Chinese tech companies, Tesla, in there as well. And that's as we saw actually a pullback in yields, Caroline. You look at the US 10-year, for example, the yield on that benchmark treasury at around 3%. It had been as high as 3.2% earlier on Monday in the early hours, of course, and Bitcoin kind of caught up in this risk-off sentiment we're seeing down below 32,000. I kind of want to look at that. Come with me into my Bloomberg terminal and look at this chart. The correlation between Bitcoin and equities broadly is very strong. And what this chart demonstrates, you have that green correlation bar on the bottom panel, 1 being a perfect correlation. We're at about 0.7 right now. But in periods where we see intense selling in the equity markets, that correlation just strengthens and it kind of flies in the face of everything we've thought about with Bitcoin as an inflation hedge, for example. Our main concern right now is that the Fed can bring inflation under control without causing recession by delivering a soft landing. So Bitcoin and equities, looking at them in the bigger picture as a whole, really one to watch. 2 stocks in particular I've been tracking throughout Monday's session. Rivian, down the most on record, more than 21%. A lockup on its shares following its November IPO expired. Reports that some of the biggest shareholders, including Ford, are selling down their stake. Then you look at Palantir, biggest drop on record, down 21%. Stock at its lowest level on record. Really tepid earnings outlook. Really, this earnings season broadly has given us some jitters, right, alongside the outlook for the Fed. And then again, those mega caps, look at those declines. You have to double check the Bloomberg and believe that Amazon and Apple continue to drop that much.
And just how, of course, can you avoid correlation when you're having such seismic shifts in such enormous companies? Right. We thank you, Ed Ludlow. What a great breakdown. And what a way to be talking about the sell-off that, of course, is a theme we're going to be sticking to throughout the next hour. Kicking things off, Victoria Green. She's the Chief Investment Officer and founding partner over at G Squared. Victoria, perfect to have your voice because what do you make of whether we're going to see capitulation in the market sometime soon, whether the correlations are all sort of working against a tech investor right now?
I don't think it's going to capitulate yet. You know, the number one investment adage right now is don't fight the Fed. And I think the Fed is going up. They're going to hike. They're going to tighten. And that's a little bit tough on tech and growth right now. And honestly, not all stocks are created equal right now. I'm kind of saying out with the new and in with the old. All of the new stuff, the pandemic darlings that are now pandemic duds, are not really performing the same as some of the old tech. You look at your IBMs, your Cisco, your Broadcoms, and more of the value tech. So right now, we really do think you want to be owning companies that are giving you the earnings now, that have a sustainable path forward on how they're going to grow their earnings, not just on a wing and a prayer and what they hope will happen. And so I think you see a lot of these stocks getting punished. I mean, Amazon's down 33% since the end of March, and that company obviously prints billions upon billions of cash. But yeah. I think investors are looking, where are we going to find growth? How are you going to grow your earnings?
Why is Microsoft off more than 4%? Are people questioning the growth of that sort of a business as well? Or is this that sort of at the moment everything, the baby goes out with the bathwater?
Yeah. It's a falling tide stalling all boats. That's a horrible way of putting it, but baby and bathwater, absolutely. There's nowhere to hide right now. If you're looking for green on the screen, it is very minimal, especially in the tech sector. I don't think there's anything wrong with earnings. Microsoft, they had great earnings, and obviously they've got good potential, but I think they're getting dragged down with everyone else. You're seeing this correlation with Bitcoin, with tech stocks, with the ARK funds. And we actually termed that the Holy Trinity, and you're seeing that correlation live up to it. It's billing right now because you really can't see one move without the other one, and you're not seeing Bitcoin be a hedge at all. You're seeing it not hedge inflation, and you're seeing it more and more develop into a tradable stock type investment that has no earnings. So what it is, I think we're finding out a little bit more what it isn't.
When you're chief investment officer, are you looking at, well, either is this a buy the dip moment and, when everyone else is fearful, be greedy, or is there something that you need to see, some sort of bottom, some sort of clearing of the deck by the Federal Reserve, some sort of sign of peak inflation before you start thinking, okay, now is a safe moment to be allocating cash?
We're not quite buyers yet of the tech sector. I think it's a little early. I don't think we've seen capitulation yet. The Fed's not going to rescue us here. I think there are some people holding out some hope that maybe they won't be as hawkish because look at how bad the market's been. But we're holding tight. We've been looking more at value. I think with tech, there are some selective names. You look at some of the semis that have sold off or cybersecurity that are very good companies. You're seeing it doesn't matter who you are, you're going down. I think it's early to come in. And if you look at the technicals, we're kind of in this middle ground right now. And I think that means there's more to fall. There's nothing to rescue us really soon.
What is the sign of capitulation for you, Victoria?
I think we need a really strong 90% down day. I think we need to find some support and some footing on the technical side. And I think, obviously, have we reached peak hawkish Fed? I don't think so. I think they're going to run off their balance sheet. So I think maybe this summer we could see it move around. I don't see us avoiding recession. So I'm not moving very fast right now because I see a little bit more pain in the cards, especially for this sector.
Meanwhile, at 4:45 p.m. New York time, it was announced by Grindr that it is going to go public through a Tiger SPAC at $2.1 billion valuation. I've seen headline after headline, Bank of America, Goldman, Citi, all these banks backing away from being exposed to special purpose acquisition companies. They're worried about the regulation effect, worried about being in some way affected by it. Do you see companies still coming to the market? Do you see still SPACs purchasing companies?
I think SPACs work when they have a target in mind and they can acquire it. It's just kind of a backdoor IPO. I think what they're trying to limit is the SPAC raising capital on hopes and dreams and not really having a set target. And you saw a lot of SPACs fail, and the banks got rich, the sponsors got rich, and the underlying clients tended to not do well. So obviously the SEC stepping in really made people back off. But similar to other IPOs, I think the SPAC is not going to be dead, but I think it's going to go back to doing what it was supposed to do, which was kind of bring a company to market with a little bit of a back door. But then it became open season, and everybody was just raising all this money to eventually go buy something, and there aren't enough targets. And you saw multiple SPACs fail. And you have to wonder, obviously, with Bumble and everything else, this is a crowded space, but Grindr has put a pretty decent niche in their market, and it is a viable product. I think they're really targeting the SPACs that didn't really have a target, and investors really got hurt by putting in money with this person knows what they're doing. They're going to be able to find this company for me, and then eventually not finding what they wanted.
There's a global element to this, of course. Yes, we're very fearful of the Fed, of inflation, of very close to home things. But of course, this is also the perfect geopolitical storm. This is an inflationary pressure that is worldwide. This is also a story of slowdown, particularly in China. How much are you looking at those global effects from that at the moment, Victoria, or are you very much focused on what's affecting the US economy?
Well, the supply chain issue in China is going to affect us greatly. We barely got out of COVID, and we kind of duct taped together this recovery. We weren't really on that solid of a footing, even though the market had this tremendous rally off those March 2020 lows. And then we look around and you see what's happening in Shanghai, the zero COVID policies in China, and the supply chain backup. We are still very vulnerable to that supply chain backup. Moving a factory and actually shoring up your supply chains, while maybe we have some other options and people are sitting on some more inventory, it's not easy to build. You can't build a factory and get it going in a year. So are our supply chains better? No. You have pressure coming from the war in Ukraine. You're cutting Russia out of the market. You have China shutting down, Shanghai shutting down. You see all of those ships backed up at the Shanghai port, very reminiscent of what was happening outside of the port of LA. and you're already putting pressure on what wasn't really a great supply chain to begin with. So the world is getting smaller. And as the world gets smaller, we cut out Russia, China's shutting down a little bit. How are you going to find your growth right now if you have less trading partners and you're paying more? So I think there's a lot of pain still to be had. I'm not an uber bear. I think we can find footing. I don't think this is an '08, but I think you need to be very aware of what you own right now and how at risk you are to your earnings holding up. Are they sustainable? And then you look at a Netflix and realize that, hey, some of these high flyer mega caps, it takes one or two bad earnings for a Facebook or a Netflix, and suddenly they lose 20, 30% of their value.
Victoria Green, could talk all afternoon to you. Thank you so much. Chief Investment Officer for G Squared. Fascinating discussion, of course, coming from what is a boutique independent advisory firm. Meanwhile, coming up, more on the tech sell-off, what that means for the IPO landscape. We were just talking about it with Victoria. We'll discuss all this and more with mobile analytics company Amplitude. That's next. This is Bloomberg.
We're seeing the end of a long era of free money that our economy and the global economy has been in, going back all the way to September 11th.
Well, it's a bit of a bloodbath out there. So companies that were already in the IPO window hoping to go public this year, that window is shut. Late stage growth companies are pulling back. Early stage companies are not getting rounds done. I mean, there's a real venture chill afoot, unfortunately.
It's certainly a tough market out there, as you acknowledge. But at the same time at DoorDash, we're focused on the fundamentals, and the fundamentals for DoorDash are incredibly strong.
We're not happy about, obviously, what's been happening with tech stocks or our stock, but at the same time, new world that we're entering. And I just think about the fundamental value proposition that Twilio provides, to our customers. Yeah, we just keep our eye on the ball, which is serving our customers. And I think that's what a lot of companies are probably just doing during this time.
Few tech executives there that we've been having across the Bloomberg Technology Show in the last week or so, reacting to the tech sell-off. We want to talk to another CEO, Amplitude's. Spencer Skates is with us. Company joined the public market via a direct listing less than a year ago, back in September. I mean, you got to the heady heights of about a $10 billion market cap, and I'm afraid it's a lot less than that now, Spencer. And of course, I'm sure you're going to say, look, eye on the prize, keep focused on the business. But what do you do when your investors must be a little shell-shocked?
Yeah, and again, I think we delivered a phenomenal Q1 result on our last earnings call. We're really excited about being out in the public markets. One of the number one things I had to emphasize with the team is that short-term market volatility is just not in your control. You can still deliver everything you commit to as a company. You can grow the business. We had one of our most phenomenal growth years last year, being up 60% year over year. And you can still get hit in the public markets because of things outside of your control. And so we're seeing that happen very broadly across the sector. Even companies that meet or exceed earnings expectations get hit. And so it really tests what CEOs and what teams are in it for the long term versus short.
Yeah, well said on that. And I'm interested as to how you make sure that your talent remains in the long term, because when you've had an exit moment, when you've, of course, people got a lot of money exposed to the share price now, how do you ensure that people remain as focused on the long term as you are?
Well, we actually brought the entire company through a whole exercise where we actually pretended we were public before we went out into the markets, where we simulated a stock price for the company, and we had it go way up, and then we had it go way down, and then we had it come back to the middle. And the key thing for everyone to understand and take away was that even if they delivered their results, even if they achieved their goals, even if they were successful as a company, that the stock price could have tremendous volatility. And so the only thing that we could control was whether we hit our goals, whether we ship products, whether we make customers happy, and to stay focused on that. And if you stay focused on that, that will result in success in the long term. Some of the best tech companies got started during downturns and recessions. Salesforce started in the early 2000s. Facebook started around then as well. Lots of great companies like Airbnb started during the financial crisis in 2008. And so it's really now is one of the best times to build and grow a large tech company. And so this is where you see a lot of noise being removed from the market, where companies who are not as good will have to go through layoffs, will have to kind of pull back their investments because money isn't available and as free as it is now as it was in the past. And it's really for those who have robust, durable businesses that will be able to weather the next few years. And so that's something that we've always done very well here at Amplitude.
The robustness of your business is also predetermined by the demand and by companies willing to spend on products such as yourselves. Do you feel like the sentiment is there, that the confidence is there for people to be buying Amplitude services?
Oh yeah, we had, that's why we were very proud of the Q1 results that we had. We had a lot of great companies decide to either come on to Amplitude for the first time, companies like Barnes & Noble or Brink Security. We had a lot of companies expand on us in a big way. PayPal was a big expansion growth this quarter. We had Square, we had OkCupid, we had IBM, we had the Weather Channel. So tons and tons of companies out there really willing to make investments with Amplitude. And that goes back to the rising power of the product organization. So, what we do here at Amplitude is we help companies build data-driven products. And so what Adobe is for marketing and Salesforce is for sales team, Amplitude is for product teams. And so all the same mega trends around people driving growth through products, so product-led growth, people needing data-driven products, digital optimization being the next wave after digital transformation, all of those data points are still very much ringing true today.
Okay, and do you have, what is it that continues to perhaps be a limitation to your growth? Is it talent? I feel that everyone's talking about how fiercely everyone is fighting for it at the moment, how they're having to pay up for it, the inflationary pressures there. Is that something you feel confident in where you currently stand, Spencer?
Yeah, talent's always a challenge for every company, and it's no different here at Amplitude. And that's honestly my number one concern. Before we went out into the public markets, people asked me, hey, what do you think the biggest risk to Amplitude is? And I kept going back to talent and our ability to make them successful here at Amplitude. We're really confident in the market opportunity here, $37 billion of total addressable market for what we do. We're really confident in that we have a best-in-class product. We had a number of awards that continue to come out about cementing Amplitude as the #1 product analytics platform in the space. So it really comes down to our ability to execute on that, and that's the talent. Now, I think in the recessionary environment, in a lot of ways, talent becomes cheaper and more accessible because there's less opportunities out there. So it's a really great opportunity for us to go play offense. We have a really strong balance sheet here at Amplitude, and we are continuing to make investments in talent across the board.
Spencer Skates, Amplitude CEO, thank you so much for making the time for us today. Meanwhile, coming up, as we continue to watch those markets, we can't forget it. Well, opening day for Meta's first ever physical store. We'll talk with the head of the store next about what they're hoping to achieve, why they chose that location. This is Bloomberg. Meta, of course, parent company of Facebook, is opening its first physical store, and it's a brick and mortar bet on the metaverse. Meta hopes giving consumers a chance to try out the VR, the AR hardware, well, that it'll boost interest in the future of digital interactions. Company's head of Meta store, that's Martin Gilead, spoke to Bloomberg's Ed Ludlow. Take a listen.
What we learn from this store will definitely go into how we build the product and where we actually continue to sell it.
Why Burlingame and not San Francisco or New York City or London?
Yeah, this is a great question. So Burlingame is the headquarters of Reality Labs, and we felt that it was important to have the customer experience that we're creating very close to where we're creating the product. We want that to be centered to how we continue to build innovation in the future. And so this felt like the perfect place to put our very first experience.
I've been in a few different situations where you see a product in pop-up format, right? You're in a mall, you're walking, perhaps in some kind of outlets area. Could you guys look at pop-ups maybe, doing temporary pop-ups in different cities around the world?
Well, I think what we will learn from this experience is where we should be and the kind of experiences we should create. A lot of the experiences that we've built in our Burlingame store are unique. It's the first time some of these have actually existed anywhere. And I'm sure, as you saw from our Quest 2 demo. And as we learn more, we'll decide where and how those should show up around the world.
Is this a luxury experience? Do you want it to be a luxury experience?
We actually want it to be an approachable experience. We want people to feel comfortable asking questions. We built it so that people can pick up the products, they can test it out. And we have these great associates so you can ask questions. And it can be so much more than what people read about. And it's one of those things where you have to experience, and that's what the store is built around.
Talk me what it's like going into the store. What am I going to touch, feel, experience while I'm there?
Yeah, so there's a couple things. Obviously, we have our products here around our Ray-Ban Stories, where you can try glasses on that offer the ability to take pictures and video, which I personally appreciated, having attended a wedding last week where I was able to actually be at the wedding while I was actually sharing it with other people. We have Portal, which actually I'm speaking to you on today, that allows you to have these conversations, not just for work, but even with family. And I think about the pandemic when my son had an opportunity to read stories to his grandmother every night, which was amazing. And then obviously, probably the most exciting thing that people see when they walk in the store is a mixed reality screen with Quest 2 that allows them to actually not just try the product, but allow everyone who's with them to see how they are experiencing the game as well. And that experience allows it to be one that is shared with many, even though it's experienced by few.
Martin, are you open to the idea that the store experiment might not work? That actually the best way for Meta to grow its hardware reach, virtual reality reach, is online?
Well, the store is not an experiment. It is a continued investment from us to make sure that we can get feedback from our consumers, but also an opportunity for us to keep building and make sure that stays at the center of what people are experiencing with our hardware.
And you're the head of Meta Store, so I'll ask you again, you want to open some more stores? And where?
I think as we learn more about how people are experiencing this, we'll be able to communicate what that means later. Right now, we're focused on what we are creating in Burlingame and the experiences that people will have here.
Martin Gilead there, of course, head of Meta Store, talking to our own Ed Ludlow. Now, a few other stories we continue to watch, and shares of Palantir Technologies actually plunging on Monday. The software maker reported mounting losses, more than $100 million of them in the first quarter, and a disappointing sales forecast. Now, the Denver-based company is known for its work supporting national defense and pandemic response for the US and its allies. Palantir is also known for, well, its polarizing co-founders, Peter Thiel, Alex Karp. 20 US internet providers will offer high-speed connections at essentially no cost to millions of low-income households. AT&T, Comcast, Verizon, well, they're among some of the companies taking part. More than 11.7 million households are participating in a $14.2 billion program already, but about 48 million are actually eligible, according to the White House. Coming up, we'll take a look at, well, the Chinese economy. This is the country's government is warning of a grave employment situation in Beijing and Shanghai, tightening those quarantine measures. From New York, this is Bloomberg. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Let's get back to the markets because, well, we've all been so focused on it for the last 3 days. And of course, the shares of Rivian are one to watch. The EV maker saw its biggest drop on record after a lockup on its shares expired on Sunday night. Bloomberg's Ed Ludlow is here with the details. Remind us, what happened with the lockup expiry? This, of course, didn't go too well for Rivian.
Right, so Rivian had this huge IPO in November, and as is often the case when they have an IPO, some of the biggest investors and insiders and employees are restricted in what they can do with their shares initially. The lockup on Sunday night basically meant that 720 million shares of Rivian suddenly became available for public trading. They could be sold. And we had news reports over the weekend that Ford, which is one of the biggest Rivian investors, had sold a block of 8 million shares at a discount from Friday's close. And it's just not good for sentiment. You know, when one of your biggest shareholders does trade when the lockup lifts, it kind of sends jitters throughout the market. And you look at how Rivian shares have performed since that post-IPO peak where they were at $172 a share. We're now down below $25 a share. The stock's fallen 87%. And all things considered, when we come to lockups, it went as badly as it possibly could have gone.
Badly as it possibly could have gone. Meanwhile, of course, there is one person, or indeed one investor, that's not selling, right?
Yeah, so Abdul Latif Jameel is a big Saudi family conglomerate. They are the third biggest shareholder in Rivian behind T. Rowe Price, a big name on Wall Street, of course, and Amazon, which is another big investor and customer of Rivian. And they told me, we have no intention to sell down our stake, to sell the shares. And they gave a very public backing of Rivian's management. But we didn't have the same explicit backing from Amazon, for example. Amazon said they were committed to working with Rivian, but they didn't comment on or rule out selling the shares at a later date. And so there's a lot of psychology around this. What's really interesting, though, is throughout the day Monday, there's lots of data to suggest retail investors are now looking at Rivian, right? It's a cheaper option. They were oversubscribed in the IPO. A lot of retail investors missed out. So there could be some upward trajectory from here, but it was just a really rough day. Biggest drop on record.
Rough day for Rivian, rough day for many. Ed, we thank you so much. Let's talk about more of that roughness, shall we call it, in the tech sell-off happening right here, right now. What does it mean in public markets? What does that spillover effect to the private markets? I want to bring in Race Capital partner Edith Young for more on this. Of course, early stage Silicon Valley venture capital fund, so not unaware of what's happening in the public markets and the race to enter those public markets. What do you make of currently? Let's talk stocks first. How much are we seeing this ripple effect affecting valuations in the private markets and people's desire to build right here, right now?
Yeah, I think as Caroline, as an investor that really focused on early stage infrastructure software, the market is brutal, and it certainly will impact a lot of the valuation in the private market. But having said that, I think that particular in the world of Web3 and Web2 infrastructure software, just there's still so much more to be built. Like for us, particularly for the early stage, I think valuation is not particular impact us yet, but at the same time, I'm still really, really bullish on some of the companies that we invested in. Still, Solana, obviously a little bit more on the crypto side. FTX is a little bit, still private. I'm so bullish on what they're building, but early stage is still missing a lot of building block. So I'm excited about Bundler, which is sort of storage for Web3, Notify, which is like communication of Web3. There's still so much more to be built, but we need to just hang tight and not get too scared with what's going on. Okay, let's talk about the crypto market, because you mentioned two companies very exposed, basing themselves on Web3 and the future thereof. When you see the biggest cryptocurrency, Bitcoin, getting hammered so much, when you see the spillover effects of VC money that's been placed into these sorts of businesses and now a pullback and perhaps that sort of risk tolerance, does that mean that people are going to be worrying about the rest of the crypto space? How does the spillover effect happen? Well, I think crypto and the Web3 space is not purely just about Bitcoin prices or token prices. It's really about the technology side of things. In my head, in many cases, Solana is basically building the AWS and the Web3 infrastructure. And not let alone that there's still backup, recovery, communication, storage. It's still not there yet. I think if we look at crypto market, if you purely just look at exchanges, obviously it's a little bit crazy. But 3 years ago, or even 5 years ago when I first got into it, Bitcoin prices were $3,000. And today it's still 10x. And 4 years ago, combined market cap about 400 billion, but today it's still over, I think, 1.5 trillion. So in that sense, overall market is not going away, but we definitely will see some ripple effect on what's going on. But I'm so super bullish because there's so much more things in the fundamental for the technology, which is not about crazy trading. It's about founders often. And I think of course, when you mention Solana, when you mention FTX, I think of Sam Bankman-Fried. SBF have been on a podcast of Bloomberg's recently, Odd Lots, by my old colleague, Jose Weisenthal. And a healthy dose of cynicism coming from SBF when it came to, well, what's happening in terms of VC money, in terms of yield farming, in terms of, what's been built in terms of, I don't know, the Lunas of this world. Do you think this is a healthy sort of rebalancing in the market that will stop seeing just money, these sort of momentum trades that are happening within crypto? Yeah, Caroline, when I spoke with Emily in December about what's going to happen in 2022, I predicted that crypto prices usually dropped in the beginning of the year, and they certainly have. And I think for us, with SBF, and I'm really, really thankful to got to invest in FTX pretty much early on in 2019. I think like the key thing is really about, making sure that we don't do crazy things. I think, investors is no longer just about investing. It's really about helping our founders to build, to make sure that we're compliant, to make sure that, operating wise, we are here to help them. And we, for many, as you just talked about, Ravian, and with the lockup, a lot of the investor just sell off right after the 6 months lockup. For many of our companies, for Solana, I've been holding since 2018. I still will hold. It's all about being long-term and not being a short-term investor. I mean, at the end of the day, I'm not a hedge fund. I'm not here to trade and make short-term money. It's really about like long-term holding, supporting the ecosystem.
The ecosystem needs to be supported with regulation as well. And of course, FTX front and center with a proposal that's going through at the moment in terms of, the future of options or derivatives and intermediation within that. I spoke to the new chairman of the CFTC a little bit earlier. And how do you feel regulation is getting to grips with this new ecosystem? I think, coming from the White House for a few, I think about 2-3 months ago, having the executive order to basically indicate that they, President Biden really wanted to support, regulate is a good sign for the ecosystem long term. And particularly with FTX, the FTT token is not available for US market. I think they make a really conscious choice to move headquarters to the Bahamas, which I went 2 weeks ago with the FTX conference, which is amazingly successful. And having a very clear line being drawn, what's being offered to the US customers versus the rest of the world is very different. In addition to FTX, Coinbase, which already gone public, is making a huge effort to make sure that we all regulate KYC, AML, compliance. This is a really good thing for the crypto market long term. And we at Raise Capital are here to support all these initiatives. Edith, it's always great catching up with you. Raise Capital partner, Edith Young. Stay well. Thank you very much indeed. Meanwhile, coming up, well, Bitcoin, we were just talking about it, slumping at a level that was last seen in July 2021. We'll hear from Galaxy Digital's Mike Novogratz on that very fact. There's the Bloomberg. Time for our crypto report now, with Bitcoin, of course, extending losses, even dropping below, well, almost 30,000 at one point on Monday. This is the first time it goes this low since back in July 2021, putting its decline from a November record high to more than 50%. Our crypto contributor, Shonali Basak, is here with more brutal selling pressure.
Brutal selling pressure. And you take a look over here, Caroline, we've been talking about this 1 year merry-go-round that crypto investors have really gone through, and Bitcoin being the brunt of that, the biggest cryptocurrency here. And you look at where we've gone more than 10% lower over the last couple of days, now getting a little bit of lift above 31,000 again. You and I have talked to Mike Novogratz a little bit earlier today with a real worry that they could fall below 30,000 if the NASDAQ also continued to decline. That is the low that he expects. Listen, but it's not just Bitcoin that we want to talk about, although there is a lot of momentum in that downward pressure there you see over the last couple of days. Let's talk about other cryptocurrencies, even stable coins. A lot of worry that you see over there with UST being unpegged to the dollar. I want to pull up this tweet from investor Jim Bianco of Bianco Research, and the worry that UST down more than 4% and under 96 cents at one point. The worry that a downward move in a stable coin like that can cause...
Backed by Bitcoin.
Backed by Bitcoin, exactly. The most important part there. Is there more selling that needs to be done to peg that stablecoin to the dollar? So there's a lot of worries here about how one asset will correlate to another asset. And let's take a listen here of what Mike Novogratz had to say about the selling pressure.
We were 40,000 literally just a week ago. And so the pace of this move has been severe, right? It's correlated with the risk off that you're seeing in all assets, right? The rise of the dollar. And so I still think 30,000 should hold. Right, we'll see if 12,000 holds the NASDAQ and we bounce in the next few days, then I think you'll see Bitcoin 30,000 will hold. If the NASDAQ falls and we head towards 11,000, there's a shot that 30,000 goes. I would tell you, getting away from price, which is hard to do in a day when the market's down 10%, it's really interesting if you just look back at all the adoption that's happened this year. I mean, the first quarter alone, venture funds have put $14 billion into the ecosystem. And so this is an asset class, right? Blockchain, digital assets, Bitcoin, that is getting tremendous investment, tremendous interest. And so while the short-term, outlook is painful, it's going to be, like I said, volatile with the rest of assets as the Fed adjusts from free money to normalized conditions. My medium-term conviction hasn't wavered. I really do still see this as a very exciting asset class with a lot of momentum.
And Mike, in for correlation, because I think that was the main hope, the prayer, the saying that was going to these institutional investors that have come into crypto, is that this is a non-correlated asset. But thus far, it's very correlated, in large part probably because more institutional players have come in and they're having to sell as they see the NASDAQ go down.
Listen, it had less correlation until there was free money forever, right? The correlation increased dramatically after COVID because every central bank took a fire hose of liquidity and sprayed it on the tarmac. And so it made all assets. You could look at the correlation of, fine wines or baseball cards or any collectible to the NASDAQ to assets. And so we're unwinding this era of free money. And so it's not surprising to me that Bitcoin, which was a hedge against free money, is selling off. I do think those correlations will break down or will lessen the moment we find some stability in the market. But right now, if you're an investor, you've got 100 fires to put out. Did you overcommit to venture? Do you have enough liquidity to pay your private equity commitments? Oh my goodness, I used to be in risk parity. That doesn't seem to be working at all anymore. And so very few people want to put on new risk in a moment of this kind of tumult. And so I think once the tumult stops, I think that's a word, tumult. Once the chaos stops, then I think you're going to see the allocators who have been doing all their homework. Listen, I just went around the country and to a bunch of conferences. I am wildly convicted that there's infrastructure being put in place to bring lots of capital into the space.
Yeah.
So again, it's surviving this unwind that investors have to manage.
When you talk about the unwind, though, Mike, you seem to be talking about a lot of people that maybe just saw the opportunity here. These weren't sort of the early adopters. These weren't necessarily the crypto faithful, if you will, at least not in the traditional sense here. For those crypto faithful out there here, do they look at this type of market and think you add to positions, you buy into this dip, or do you just kind of stay the course and wait for whatever shakeout is happening to end?
Listen, for the guys who have been in crypto a long time, longer than me, this is par for the course. Mm-hmm. For most people who manage institutional money or manage lots of money, this is unbelievably painful. And so you use the same kind of risk analysis you do when you're trading other assets, right? I would tell you, though, that the new institutional players that are coming in with a very long-term focus. I mean, and you can put BlackRock and Blackstone and Citadel and Apollo into that bucket, right? Those are four of the biggest names in investing, and that they're getting in, right? They're working on infrastructure and trying to help create institutional frameworks to bring their clients in. Mm-hmm. And so I don't think this asset class is going away because we've had a 50% sell-off.
Oh, your clients, your analysts today have been asking you about the recession probabilities and how you prepare for that. How do you prepare for that?
So I think we are going to go into a recession. In some ways, that will be good for crypto because it will finally get interest rates calm and down again. Like, I'm sure we'll have crypto adoption both from investors. We're already seeing it with companies, right? So, but asset classes prices always get ahead of where the actual, building of a company is, right? Tesla wasn't even selling cars, and they had a decent market cap. And so you got to keep the story up until you can build product that then generates the revenue. That's the process that's happening in crypto. And so what crypto needs is stability in the non-crypto markets. At that point, you'll see stability in crypto and you'll see fast adoption.
And Caroline, that was, of course, Galaxy Digital's Mike Novogratz. Galaxy Digital, MicroStrategy, both of these companies dropped more than 25% today in the market. So you see that crypto decline actually exacerbated a lot more in those firms exposed to cryptocurrencies.
Talk to us about exacerbating. Do you think that the pressure with Luna and the fact that a Bitcoin-backed stable coin means that you have more selling pressure on people, on their, on their treasury. Is this going to be a really ugly feedback loop?
That's the big concern here, that there could be ripple effects across DeFi markets. The question is, how low does that peg have to go? How much decoupling does there have to be, and how long does that have to last for the Luna Foundation, for UST to keep on having to sell Bitcoin into that decline?
Shonali, always so smart when it comes to crypto. We thank you for that, and indeed the interview with Mike Novogratz. Meanwhile, coming up, continued coverage of the market meltdown. That's what we're calling it, as investors worry about the Fed's ability, like what we did there, to curb inflation without throwing the economy into a recession. Michael Antonelli is with us at Baird. This is Bloomberg. Let's get back to the sell-off that we've seen across, well, every asset class today, basically, apart from bonds. Stocks tumbling to a new 13-month low. Michael Antonelli is with us at Baird, joining us to discuss the tech side of this in particular, because it was the NASDAQ 100, now basically in correction mode, down 10% in the last 3 days. How much further do we fall before capitulation?
Well, you don't have to go very far to look for superlatives about how bad it's been for the NASDAQ. You're talking about a 25% drop year to date, which is the worst start to a year on record by a lot. The next closest is 1973, which was down about 17%. So, not only that, my friend Luke Kawa, Bloomberg alumni, he said this is the biggest non-recessionary 6-month contraction in the NASDAQ 100's forward PE in history. So this repricing just been vicious, very vicious and very rapid. But when you think about the last few years, maybe this is starting to make a little bit of a sense. If you were to look at the past, say from 2019 to the end of 2021, the NASDAQ is up about 164%, the NASDAQ 100, annualizing at about 38% a year for 3 years. That's a lot. That's a lot. When you look at this pullback, it makes sense from the perspective of the Fed is hiking rates. We're trying to take some steam out of the markets. We're trying to tighten financial conditions. Mike, why didn't you tell us about this at the start of this year? Well, using valuations is a very, very difficult tool. It's proven to be historically difficult.
Historically difficult, but what sort of depths have we plumbed in terms of valuations vis-a-vis the rest of the years? And indeed, why is company, I can understand the thesis of like get out of companies that don't have any E in their PE. But what about companies that really do, like Apple, Amazon, Microsoft? Why are they sort of being thrown out?
I mean, those are certainly the largest holders and the ones that we watch the most, because if those crack, that really portends a very bad market. If you look at some of these really big names, one of the things I was looking at today is the fact that most of their big drawdowns, okay, the things like just throw a couple out here, like Facebook and Apple and Nvidia, their biggest drawdowns recently were in 2018, 2019, not during COVID. So they were during this pandemic crash. They were about rate hikes. Same thing back then, 2018, 2019. So it's very, very similar. Multiple compression. The Fed just takes these multiples out of the system. And if you look at some of the high flyers, you notice that all of their COVID multiple expansion is completely gone. Earnings are actually doing okay. So it's all this Fed-driven multiple compression. Where can it go to? I mean, right now, I looked at NVIDIA and Adobe, and they're both at roughly the same forward PE as Clorox. I don't know what that says about.
Clorox did pretty well today, Michael. Clorox did pretty well.
I don't know whether all three of those are too expensive, but Clorox, Adobe, and NVIDIA kind of have the same forward PE right now.
Okay. Is there any technical lines, any assets that you're looking at? Because it was interesting today, correlation started to work in a different way. We actually saw commodities get caught up in this selling. We saw bonds finally become some sort of haven trade. What are you looking for in terms of where to catch up where tomorrow's trade is going to go?
I thought that was important too. I really did. I was watching the 5-year note when I woke up, because I just kind of view that as a good proxy for the terminal rate. And it was up to 310, and then the yield started plummeting down to 295. I like that. That's maybe a little bit of flight to safety, which we haven't seen for a while. You see that oil trade down, that means maybe people are having to sell their winners, having to sell the things that have been doing well this year. That's important. That's a little capitulatory to me. I look at two things. Like I said, that 5-year note, I want to know that the terminal rate's at 3 or less. I need that to stabilize. And then I look at something called discretionary over staples, and I equal weight them to kind of take out Amazon and Tesla. So I equal weight them. And that's what my friends at Strategas call one of the best strategists in the world. It's kind of a look at risk on, risk off. So I'm watching that. I need that to make a low. It hasn't. It has not yet. So discretionary over staples, equal weighted is a good proxy for risk on, risk off. I need that to find a bottom too.
Michael, love how you push us forward. We thank you. Michael Antonelli, of course, a Baird. Meanwhile, that does it for this edition of Bloomberg Technology. But we'll continue to follow this ongoing sell-off and the impact it's having across the board. We'll be back here tomorrow, joined by Tony Fadell. Of course, he's got his new book, Build, an unorthodox guide to making things worth making, as well as get his thoughts on the tech markets. We'll also be joined by Falcon X's head of institutional coverage. Of course, we're talking crypto. This is Bloomberg.